Are you ready to start investing?
Do I sound ready?
So you can build wealth and achieve your financial goals?
I always wanted to own the Dallas Cowboys.
Well, this video will be your beginner's guide on how to start investing in Canada the proper way with minimal risk and the greatest chance of achieving your financial goals.
It's not the Dallas Cowboys, but it's a start. Oh, the Denver Broncos!
Step 1, build your financial base. Before you invest, there's two things you must do. The first thing, build an emergency fund of $2,000. This $2,000 will not be invested and only used for unexpected expenses like your car breaking down or your roof leaking. You can easily get this $2,000 by selling stuff you got laying around collecting dust. Or the old-fashioned way, by not buying so much stuff and getting another source of income like a part-time job. The next thing you must do is pay off all your high-interest debt.
The joke's on him, I'll be dead by then.
Basically, any debt with an interest rate higher than 8%. So your 20% interest rate credit cards, your 10% personal loan, and your 8% auto loan. The reason you want to pay off high-interest debt first is because it's like a guaranteed risk-free return. A good rate of return in the stock market is 10%, which is the average for the S&P 500 index. But if you have 20% credit card debt, you're still losing money, plus you've created more unnecessary risk by investing. Once you get your $2,000 emergency fund and you're starting to pay off your debt, the next level of financial security would be to dedicate additional funds to growing your emergency fund. It's recommended to have 3 to 6 months of bare bone living expenses in your emergency fund. This way you can handle every emergency that comes your way, including job loss. This emergency fund may take a while to fully fund, so you can start investing while building it up. Also, the reason you need an emergency fund before investing is because if an emergency happens, you may need to sell your shares in your portfolio. And the stock market has volatility, meaning your portfolio can be down one day and up the next, especially in the short term. So you may need to sell your shares at a loss in order to pay for an emergency. Step 2, define your financial goals. Do not overlook this step. The point of investing is to achieve some financial goal. Yeah, maybe you just want to grow your money and build wealth, but that's a goal. And it's better to be more specific. Grow your money for what? Build wealth for what?
Turn down for what?
You need to set clear short, mid, and long-term goals. Short-term goals will be goals that will take 1 to 3 years to complete. So like a vacation, funding your 3 to 6 month emergency fund, or a down payment on a car. Midterm goals are goals that will take 3 to 10 years to complete. These will be goals like saving for a down payment on a house, a wedding, or starting a business. And long-term goals will be goals that take 10 years or more. This will be retirement, your children's education, or a rental property. Now you can't just create a goal. You need to figure out how much you need to contribute and when will the goal be complete. To learn more about setting financial goals, check out this video up here or look for the link in the video description below. Step 3, choosing an investment product. The reason why you want to create financial goals is because this will determine your appropriate investment product and asset allocation. Short-term goals means you will need the money sooner than later. So short-term goals require risk-free investments like a high-interest savings account, high-interest savings ETFs, or GICs. High-interest savings accounts are the safest, most flexible way to hold your money. With this comes the lowest interest rates, especially if held at the big 5 banks. GICs are like high-interest savings accounts, but your money is locked in for a period of time at a locked-in interest rate. GICs tend to have higher interest rates than high-interest savings accounts. As for high-interest savings ETFs, they have rates similar to high-interest savings accounts. The main difference is that these ETFs are traded like a stock on the stock market. Next, for midterm goals 3 to 10 years, you may be able to tolerate more risks. And with long-term goals, you may be able to tolerate the most risks. So this will be a mixture of equities and fixed income. This is where your asset allocation comes in. Asset allocation is just how you split up your portfolio among different kinds of assets. Now, there's no formula for the right asset allocation for everyone, but basically, the less time you have, the less risk you want to take. So let's say your goal is 10 years away. The first 3 years, you can have 80% equities, 20% fixed income. The next 4 years, 50% equities, 50% fixed income. And the last 3 years in 50% GICs and 50% in a high interest savings account. If your goal is 20 years away, for the most growth, you can have 100% in equities and slowly allocate less the closer you get to your end goal. Your equities will be either individual stocks or ETFs, which is a combination of multiple stocks. And your fixed income will either be bonds, treasury bills, or a combination of them in ETFs. As for buying individual stocks, this will be the most time-consuming and riskiest way to invest. It's recommended you have at least 25 to 30 different stocks in different sectors, in different regions, with different market caps to be diversified. Although this is the riskiest portfolio, it offers the highest reward if you can pick the right stocks.
He got me invested in some kind of fruit company.
But statistics show that you may be able to beat the market sometimes, but over a long period of time, the market will outperform your custom-built stock portfolio. What do you mean the market? The market is the benchmark of investing returns that is represented as the S&P 500 index. These are the top 500 stocks in the US, which collectively return an average of 10% a year over the long term. Now, if picking individual stocks is too much work and you still may not even beat the market, this is where ETFs come in. You can essentially just buy a S&P 500 ETF and be well diversified and not have to worry about researching stocks and staying up to date with them. The point of ETFs is diversification. The more broad market the ETF is, the more diversified it is. The less broad it is, the more risk you have, but potential for higher returns. So you may want a multiple ETF portfolio. This could be different sectors, indices, market caps, geographic markets, and so on. But to keep it simple, let's take a look at the 3-fund portfolio. This will consist of 3 ETFs, 1 domestic broad market ETF, 1 international broad market ETF, and 1 broad market bond ETF. And the only thing left to do is keep contributing, keep purchasing, and rebalancing according to your recommended asset allocation. Now, what if I told you there is a simpler ETF portfolio?
Why didn't you tell me this earlier?
Enter all-in-one ETFs. Just buy 1 ETF according to your asset allocation, and boom, you're diversified and don't need to worry about rebalancing. This is the most simple way to invest using a self-directed online broker. But there's an even easier way to invest, and that's with a robo-advisor.
Meet Morpsy.
Investing with a robo-advisor is as simple as it gets. With a robo-advisor, they build your portfolio made up of ETFs according to your financial goal. They purchase more shares as you contribute more money, and they do the rebalancing. You don't need to do anything, and you don't need any knowledge of the stock market. As for mutual funds, you can simply just go to your bank and tell them you want to invest. They will automatically invest you in mutual funds.
We can put that check in a money market mutual fund. It's with compounding interest, and it's gone.
This is because it's the most lucrative for them, meaning higher fees and lower returns for you. Mutual funds are better than not investing, but something as simple as a robo-advisor would be more beneficial to your portfolio. To sum up investment products, buying individual stocks and bonds will require the most work, will be less diversified, which means more risk, and they will likely underperform the market long term. The benefits, potential for higher returns, and no management fees. Multiple ETF portfolios have ETF management fees, but are very minimal and will require very minimal work. Returns and risks will depend on how broad you diversify. All-in-one ETFs have less work than an ETF portfolio, but have higher management fees. Risk and returns depend on the asset allocation of the all-in-one ETF. Robo-advisors have the least work required, but have the second highest management fees. Returns and risks depend on the recommended portfolio. And mutual funds have management fees that are 2 or 3 times higher than a robo-advisor and will likely underperform the robo-advisor. Other financial instruments include REITs, options, derivatives, Forex, crypto, commodities, peer-to-peer loans, hedge funds, and private equity. But this is a video for beginners, so let's stay away from these. Step 4. Decide on an investment account. In Canada, there are many different accounts to choose from. The 2 main categories are registered accounts and non-registered accounts. For registered accounts, there is the cash account, which every platform will offer and has no tax advantages. There's the joint cash account, which is the same, just joint with another individual. And there's the margin account, which allows you to borrow money to invest and also has no tax advantages. And I guess there is a regular high interest savings account, which once again has no tax advantage. For registered accounts for beginners, you have the TFSA, RRSP, RESP, FHSA, and the RDSP. Now there are other registered accounts, but are mainly for those who are retired. All these accounts will offer some kind of tax advantage. First, let's take a look at the TFSA, the most flexible account and can be used for any financial goal. The main benefit of the TFSA is that any income earned or capital gain can be withdrawn at any time completely tax-free.
Oh shit. Tax-free? Tax-free.
The biggest con of the TFSA is that there is a limit on how much you can contribute depending on several factors such as your age. If you don't know which account to pick, the TFSA is a good start. The next account is the RRSP. This account is for the financial goal of retirement and works completely different from the TFSA. Any contributions to an RRSP are tax deductible, meaning it will reduce your taxable income, which can lead to an overpayment of income tax, and that overpayment might lead to a higher tax return. So more money for investing. Also, any investment growth is tax deferred, meaning you won't pay any taxes as long as you keep it in the account. And before you consider an RRSP, talk to your employer to see if they do RRSP matching. If they do, it's essentially free money and you'd be crazy to turn that down. Now for the cons, your contribution limit will depend on your taxable income, and when you do withdraw, it will be taxed as income at your marginal tax rate. The trick with an RRSP is to contribute when you're in the highest tax brackets and withdraw when you're in the lowest tax bracket. That being said, you can withdraw from an RRSP at any time. You just need to consider the tax implications. And just because your financial goal is retirement, that doesn't necessarily mean the RRSP is right for you. There are many other factors and considerations for all these accounts that I can't fit in this video, so make sure you do your own research before deciding on an account. That being said, I have videos for the TFSA, the RRSP, and the next account, the FHSA. This account is for those who are saving up for buying their first home. It combines the best benefits of the RRSP and the TFSA in one account. Contributions to an FHSA are income tax deductible, any growth in the account is tax-free while in the account, and withdrawals are tax-free as long as you use the funds to purchase a qualifying home. Then you have the RESP. This account is for your children's education. The benefits of this account is the savings grant that matches 20% of your contributions up to $500 per year for a maximum of $7,200 per child. Also, contributions grow tax-free within the account, and any growth and grants are taxed at the student's hand, which typically has a lower tax rate. Then any contributions you made can be withdrawn tax-free. The con with the RESP is if the child doesn't go to school, but the grants and growth can be either transferred to another child or transferred to an RRSP. Note that there is a lot of misinformation about the RESP, even from professionals, so make sure you really understand this one. And finally, the RDSP. For persons with disabilities. This account offers tax-sheltered growth, matching grants up to $70,000 and $20,000 in savings bonds for low-income families. The con with the RDSP is that there are many complex rules, and any withdrawals before 60 may result in penalties. And like I already mentioned, there are many rules to all these accounts, so do your research before choosing one. Step 5, choose an investing platform. First of all, if you're just looking for the best rates for high-interest savings accounts and GICs, check out highinterestsavings.ca. Here you find the highest rates available in Canada. And surprise, surprise, the big 5 banks aren't there. For online brokers, there are many in Canada to choose from. The one suited for you will depend on your personal situation. However, Wealthsimple is considered one of the best beginner platforms and one of the best platforms in general. They have an easy sign up, which can be done through your mobile device. They have a simple and easy to use user interface. They have stock lending, instant transfers, fractional shares, reoccurring deposits, reoccurring investments, and dividend reinvesting. And the best part, interest on cash balances, no account minimums, no maintenance fees, and no commission fees. This means you can use this platform to buy and sell stocks and ETFs with no fees. But there is a catch. This is only the case when buying Canadian listed stocks and ETFs. If you want to buy US listed stocks, there will be a 1.5% foreign exchange fee every time you buy and sell, unless you sign up for the US dollar accounts, which are $10 a month, unless you have $100,000 in assets with them. You will still need to pay the 1.5% exchange fee, but once you exchange for US dollars, you can hold US dollars so you don't need to keep paying it every time you trade. The $10 a month might seem expensive, but if you were to go with a popular investing platform like TD Direct Investing, the commission fee is $10 a trade. And if you're doing multiple trades a month, they quickly add up to way more than Wealthsimple. That being said, if you're creating an income dividend portfolio, a multiple ETF portfolio, or an all-in-one ETF portfolio, this can be achieved with all Canadian listed stocks and ETFs. So you don't really need to worry about exchange fees unless you're creating an individual US stock portfolio. And if that's the case, you should consider other brokers like Questrade or Interactive Brokers. Questrade comes with free US accounts, and if you use Norbert's Gambit, you'll pay a lot less in exchange fees. And with Interactive Brokers, they have a foreign exchange rate that can't be beat. But all these platforms have their pros and cons. So if you want a more detailed guide on the best brokers in Canada, check out this link up here or look for the link in the video description below. As for a robo-advisor, your three best options are Wealthsimple Managed Portfolios, Questrade Portfolios, and RBC Ease Invest. Wealthsimple for user experience, Questrade for lower fees, and RBC Ease Invest for possible higher returns. Before picking an online broker or robo-advisor, make sure they offer the investment products you want and the account type you want. Step 6. Funding your account. Once you create your account with your investing platform, you'll need to fund your account. The first option for funding your account is linking your bank and doing an electronic funds transfer, which may take a few days to clear. But with platforms like Wealthsimple, you can do this transfer and have your money instantly. The amount you can transfer instantly will depend on several factors like assets and past deposits. Doing this kind of transfer is typically free, and this is the preferred method for transferring large amounts. Then there is the e-transfer. This transfer usually takes an hour or so to complete, and there's usually a maximum of $3,000 a day. You also have Visa or MasterCard debit. This is instant, and the maximum is usually $3,000 but can be high as $10,000. Another method includes adding the financial institution as a bill payee and transferring money like you're paying a bill. This method may take a few business days to complete. Other less popular methods for funding your account include a wire transfer, which can be expensive, and a direct deposit. Step 7. Purchasing your investment. Once you have funded your account, you're ready to start investing. If you're using a robo-advisor, you won't need to worry about this step because the robo-advisor will handle all this for you. But let's just say you're trying to buy an ETF. The first thing you want to do is find the search bar and type the ticker symbol of the ETF you want to purchase. Double check to make sure it's the right one, checking the name, market data, currency, and exchange that it's on. Then click buy. Then enter your order type, which for 99% of investors who dollar cost average, this will be just a market order, meaning your order will be filled at the lowest available price at the moment. Now you can purchase by either the quantity of shares or dollar amount you want to spend. Then you review the order and done. If the market is open, your order will likely be filled in a few seconds. If the market is closed, it will be filled once the market opens again. Selling your shares will be pretty much the same process, just selling. Step 8. Set up automations. The first automation you want to set up is a reoccurring pre-authorized deposit or a reoccurring online bill payment. This is automatic cash deposits from your bank account to the investing platform. This is something you can set up weekly, bi-weekly, or monthly. This will ensure that you steadily contribute to your portfolio and ultimately reach your financial goal. The amount you deposit will be the amount you decided when you created your financial goal and time horizon. The next automation is reoccurring investments. With a robo-advisor, you don't need to worry about this because it's already handled, but for stock and ETF portfolios, your options are limited. As far as I know, Wealthsimple is the only platform that allows for auto purchasing of stocks and ETFs. And Wealthsimple also has fractional shares, so you could auto deposit $100 a week and auto buy exactly $100 worth of a stock or ETF. Next, you want to set up automatic dividend reinvestments, meaning once you get paid your dividends, they will automatically reinvest it back into your stock or ETF portfolio. Once again, Wealthsimple is the only platform that offers a simple solution to reinvesting your dividends. That being said, you can always set up a DRIP, a dividend reinvesting program. This is a great option for other platforms that do charge commission fees, as DRIPs are commission free and automatic. The problem with DRIP is that if your dividend is not enough to purchase one full share, it won't happen. So this is pointless for smaller portfolios. And setting up a DRIP isn't as easy as pressing a button. You'll need to fill out a DRIP application and send it in to get processed. Step 9, rebalance or reassess asset allocation. If you have a robo-advisor, you won't need to rebalance, but you may need to update your asset allocation. Usually the platform will remind you to update your information to see if your portfolio needs changing. If you have an all-in-one ETF, you will also not need to worry about rebalancing, maybe just switching to a less risky all-in-one ETF the closer you get to your goal. If you have a multiple ETF portfolio or a stock portfolio, you'll need to buy and sell shares till you rebalance your portfolio so it matches your desired asset allocation. For example, if you have 10% of your portfolio in Canadian Tire stock and it grows to 20% of your total portfolio, you may want to sell some of it to get it back to 10% and buy more of the stock that is down. Step 10, withdraw. Once you reach your financial goal, it's time to withdraw. The best thing to do, especially for larger portfolios, is an electronic funds transfer directly to your bank account. This process is usually free and will take a few business days to complete. If you have a TFSA, there will be no tax implications. If it's an RRSP and over $15,000, 30% will automatically be withheld. Then when tax time comes, you'll need to report that withdrawal. And depending on your taxable income, you may get some of that withheld RRSP back, or you may need to pay more taxes on it. If you have an FHSA, you can withdraw without any tax consequences if you make a qualifying withdrawal to purchase your first home. You may need to fill out a request form with your brokerage, and later you will receive a T4, which you'll need when you go to do your taxes. If using a cash account, any income earned or realized capital gain or realized capital loss will trigger a tax event. 50% of capital gain is taxable, meaning if you had a capital gain of $10,000, 50% of that, $5,000, will be added to your taxable income and taxed at your marginal tax rate. This 50% can be as high as 66.67% if your capital gain is over $250,000. Dividend tax is a bit more complicated, which involves eligible or non-eligible dividends and possibly a dividend tax credit or a foreign withholding tax. As for fixed income, this is taxable at the same marginal rate as ordinary income. And there you have it. This is the proper way to invest with minimal risk and with the highest success. I know this video was long, but there's a lot to know and a lot you still need to know. So if you want more details on some of the things I talked about in this video, watch one of the videos on the right of the screen. See you there.